Welcome back to another episode of Retire Right. I'm Ryan Wyatt, and per usual, I'm joined by my compadres on the Committee of Investments at Wyze Wealth, Ron Wyatt and Nick Lewandowski. Gentlemen, how are you on this fine Tuesday?
Doing well.
Doing great. The weather is like way better.
Incredible.
Really lifts your spirits.
I've already got a couple rounds of golf under my belt. What's new and exciting with you guys? Anything?
Just got back from visiting the parents in Florida. Weather was incredible. Great couple weeks.
Yep. Nice.
We have an 8-month-old whose sleep is regressing developmentally because of the stage she's in. So yeah, that's where we're at in our household right now.
Not as exciting as, well, I shouldn't say not as exciting. That's bad. But it's not sunshine in Florida, I guess.
Yeah.
No.
He's working on his second pot of coffee right now.
Yeah, exactly.
Yeah, right. Today we're going to talk about a concept called tax loss harvesting. This is something that we are really big advocates for. We think it really just, when it comes to managing money, it's just something that you should be doing for your clients. So we're going to break that down and really hope that this just educates you on, I guess, the importance of it, what tax loss harvesting is, how it works, and maybe even get into what tax loss harvesting done wrong could look like, because there's some specific rules and things that you should be aware of. I'm just going to start very, very quickly by defining what tax loss harvesting is. So and I'll do it in broad strokes because we're going to break some of these points down in more detail later on. But really, tax loss harvesting is a way that you can stay in the market but generate investment losses that can be used to offset future gains. The staying in the market piece is the really important part, because if you aren't tax loss harvesting, and let's say that you wanted to generate investment losses to offset future gains, what you would be doing is selling an investment that has experienced losses, which would go to cash. That's how you would generate those losses. So we're going to tell you how to actually do tax loss harvesting, which again is staying in the market while realizing those losses that can benefit you from a tax standpoint.
Right. One thing I'd like to add is that normally the opportunities to do the harvesting will occur during bear markets when volatility is very high.
Okay. Nick, I'm going to kick the first question over to you. I know I loosely explained what tax loss harvesting is already, but just want to see if there's anything that you would want to expand on further.
Yeah, so that's a great intro. So you kind of described the basic idea. You have a position that has gone down, and for tax purposes, it shows a loss. The reason that's valuable is the way the tax rules go. When you sell that loss first will offset other investment gains you have for the year, other capital gains you've realized, if you have any. And if you don't have gains, or if your losses exceed the gains that you have and you've wiped all the gains out, then you can offset up to $3,000 of your other income, taxable income in that year with the loss, to reduce other taxable income. If you exceed that, you get to carry it forward.
Okay.
So, if you have something that's gone down a lot in a bear market, the silver lining is there's this opportunity for this tax planning piece that can be extremely beneficial for the current and future years.
Right.
So let's pause there and break that down a little bit further. Mm-hmm. So let's say you have position A and position B, and let's say you sold both in the year. Mm-hmm. So position A, let's say you bought it at 50 and it goes up to 100 when you sell it. So you have a $50 gain there.
Got it.
Okay. And then say the same with position B. Say you bought it at 100, went down to 50 and you sold it. So you have a 50 loss. Mm-hmm. So what you're saying is that loss would perfectly offset that gain. Mm-hmm. So your net tax exposure is zero.
In your example, that's exactly right.
Okay.
And the other thing I just wanted to mention too is when Nick said that you can carry forward, think about putting it's almost like a piggy bank, right? So you can carry that loss forward for the rest of your life.
So let's give a simple example there. So say again, go back to the original example, security A and B. Say you didn't sell security A.
Right.
You have a gain of 50, but you didn't sell it.
Right.
But you did sell security B. So again, you bought security B at 100, You sold it at 50. You have $50,000 of losses that you've realized.
Right.
And what are you saying about the carried forward
So
part there?
what you can do is, like Nick said, is this to say you have no other gains this year, so you can offset $3,000 of against your income. So now going into 2026, you have, instead of 50 left, you have $47,000 of losses left. In 2026, again, you can offset $3,000 of income and any gains in that year. You can use that against gains in 27 and 28 until it's all used up.
Yeah, and the key point to make there is that those, that piggy bank of losses, that's indefinite. You carry that forward in perpetuity. It does not go away until it's used.
Until it's used, or you pass.
So I know, Nick, that was kind of like the first part point we're gonna make there was, how to capture the tax loss. Can you take it a step further? We can stick on the kind of the same example, but in that first example that I gave you, you were taking yourself out of the market. So how do you realize that loss without taking yourself out of the market or selling at a $50,000 loss and just going into cash?
Yeah, so there's a really important tax rule related to this that pertains to this. It's called the wash sale rule. And the reason the wash sale rule exists is without the wash sale rule, what we would all do is just sell, the security that's down, realize the loss, and buy it back immediately to stay invested. And the wash sale rule is designed to prevent that from happening. So you are realizing real losses and not just these paper losses.
Right.
So the way that works is if you have bought that security or sold that security or if you bought that security, because we're selling it in the wash, in the harvesting example, if you bought the security in the prior 30 days or the following 30 days to the sale you're using to capture the tax loss, the loss is disallowed. It doesn't count. And also, so the way you get around this is you could just sell the security, sit in cash for 30 days, and then buy it back, and you're outside the window.
But that doesn't factor in. Right. Yeah,
the
once that stock starts running again,
then you just had the benefit was negated by this.
You sold it to somebody that got a really good price for it, and then when you go to buy it back, you're buying it at a premium.
Right, which doesn't make sense.
That I'm using.
Exactly. So there's this provision in the wash sale rule that if the security, you can buy another security, and if it's similar but not substantially similar, there's a lot of nuance in that wording, the loss won't be disallowed.
Right.
So for example, you could sell an S&P 500 ETF, capture the loss, and buy a US total stock market ETF, stay in the market. From an investment perspective, the exposure is pretty similar, but the IRS isn't going to disallow that loss.
Yeah, so I think the exact language that the IRS uses is that it can't be identical.
Yeah.
So, you couldn't sell Apple and then rebuy Apple. Right. That's going to trigger the wash sale. But let's say that you're using, exchange traded funds, which we use in our portfolios, and you buy an exchange traded fund that has a lot of similar exposure to the one that you sold. That's okay. That's how you again sell at the low, realize the tax benefits, and stay in the market is by rebuying a similar type investment. Next, the other question I had, and Ron, I'll kick this one over to you, is why would you say that tax loss harvesting is important? And it's kind of a two-part question. How does it benefit our clients?
The answer is very simple. You just save taxes. So there's really two benefits to it. Number one, you generate this loss, but you should be in a similar situation in the market. So if the market goes up, you make money. If it continues to go down, you would lose money, very similar to the original investment. But that loss can be used, again, to reduce income taxes and primarily future capital gain taxes, right? So it just reduces taxes. But the other thing, too, is let's just say in your example, Ryan, you bought something at 100, it goes down to 50, you sell it, and you buy something else with the $50,000, okay? Say you hold that for the next 15 years. From 50, it goes up to 300, okay, as an example. If you sell it, the investment's worth 300, but your cost basis is reduced to 50, right? So if you sold it, you have a $250,000 gain. But if you pass away with it, the gain disappears. It gets stepped up, right? So what our goal is to try to be as tax efficient while people are alive, and then upon death, there's a stepped up basis, right?
Yeah. Pass assets tax efficiently.
Exactly.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
So the key point here is that it's kind of a double whammy in terms of benefits. One, there's the tax benefit, obviously, which we've been talking a lot about. But then two, the second benefit is that we spend a lot of time and energy figuring out the optimal allocation for our clients, testing their risk tolerance, putting together a financial plan. So this strategy not only yields those tax benefits, but we're doing that while keeping them in that appropriate allocation, which we spend a lot of time determining what that is.
And then the other thing I should have added is specifically in non-retirement accounts and taxable accounts, we're also using investments that are very tax efficient, right? So we're generating losses when we can, using tax efficient investments for the long haul and getting a stepped up basis later. So it's like having your cake and eating it too, without gaining weight.
Yeah. All right. So Nick, I'm going to kick this one to you. So what does tax loss harvesting done wrong look like?
So we've covered a lot of this already. There are really 3 points I want to make here. First one, we talked about wash sales. Gotta be mindful of the wash sale rule so the losses aren't disallowed, because then you don't get the benefit. Second one is what you guys were just talking about, which is you need to integrate the tax loss harvesting in a plan with like the replacement buys and all that. So when you're capturing these losses, you're not moving the portfolio too far from the investment allocation that you want for risk and return reasons. Like, you open this up by saying if you just sell a bunch of things to capture losses and then you sit in cash, that can kind of do more harm than good over the long term.
Especially if the market rallies in that 30-day period, right?
And along those lines, the third point, which is builds off the second one, but is a little bit new, is one thing I observe with some clients, like clients have a different level of tax sensitivity, right? Mm-hmm. No one likes taxes, but there's a lot of clients who are like, look, I make money, I pay taxes, I get it. And then on the other end of the spectrum, there are people who I maybe unfairly describe as I will spend $1.10 to save $1 in taxes, who are very, very tax sensitive. Right. And if you're on that far end of the spectrum that I just described, you need to be careful that you don't try to give into this perverse impulse to like realize losses all the time. Yeah. I mean, the losses are real losses, right? Like it went down. So sometimes people can be a little bit obsessed with pursuing tax losses and so focused on that because of reducing taxes that you lose sight of that bigger picture. And that's why everything we have talked about here is about, yes, we harvest, but it's also integrated with the rest of the plan and the investment strategy.
Understood. Ron, what does our tax loss harvesting process look like?
So anytime we're getting into a correction or a bear market, when volatility picks up, our software is very sophisticated, so we can run reports on any day. And then what the reports will show us is in non-retirement accounts, what positions have losses. What we're looking for is if it's a 1, 2, 3% loss, it's not worth doing anything. But if the losses start getting to be 10, 15, 20%, we'll consider that. So we have a minimum dollar amount, which is not very high, and a minimum loss amount. Because our belief is if you're going to make a trade, make sure it's impactful, right? Just don't do it to do it.
Right.
And so if we can generate a decent loss, we'll sell our preferred investment to go into something similar, okay? After the 30-day period where the wash sale no longer applies, our preference would be to go back to the original investment as long as that doesn't create much of a gain. If it creates a gain, we're very comfortable sitting in our alternative investment, the replacement investment, I should say, because it has the same basic, types of, it's the philosophy of the two are very similar, right? The types of holdings and I'm not saying it very well, but basically the philosophy is the same.
Yeah, I want to make one point, then I have a question. Just in case we have not been clear with this yet. I know we've hinted at it a couple times, but this like, whatever you want to call it, tax planning strategy or an investment management strategy is, again, specific to non-retirement accounts, because when you invest inside of an IRA, whatever happens in that IRA does not matter. If you buy things at a gain, or if you sell things at a gain, sell things at a loss, have dividends that are, kicked out of the investments, whatever happens inside that IRA does not matter. It's only when the money leaves the IRA that you have to worry about taxes. When you're investing in a non-retirement account, it's a whole different game. Dividends, they're taxable to you. When you buy or sell something at a gain or loss, taxable. Those are taxable events. So again, this is specific to non-retirement accounts. Ron, the question that I had for you was, so obviously you guys, spend a lot of time constructing the portfolios, whether it be the proprietary stock strategy, Wyze Direct, or the exchange traded fund strategy that we use. So you have the original lineup for the, let's focus on the exchange traded fund part. You have the original lineup there of exchange traded funds. What is it? Do you have like a secondary list of investments that are, mapped to that, so that when you do generate this loss, you immediately know what you're going in? Or is it, hey, I have to shop around and figure out what I want to buy?
We know ahead of time what the replacements are, and they're very similar. If one is a U.S. Large company, high profitability, we have a replacement for that too. So very similar. So again, we prefer to go back to the original, but we're okay in definitely holding the replacement because it's very similar.
Now, should a client look at this as like, oh, the original portfolio before tax loss harvesting, that's kind of like the A team, and you're more confident in the A team, and the secondary list of investments is the B team, or you just as confident in the B team?
I'm just as confident. Even on the bond side, for example, we might use Vanguard and Spider for intermediate treasuries. You don't need to do it just on equities. You can do it on bonds too. And I think Vanguard might be at 4 basis points the cost, which is 0.04, where a Spider might be 0.06%. I mean, so it's like nothing, right? So our replacements are I'm very comfortable keeping them indefinitely. Is
there anything else that either one of you would want to say? Because I know like the one really good thing about our investment strategy is that we do have beliefs and we follow those, and because we follow that, we have a disciplined and repeatable process. So is there anything else that you guys would want to mention that ties tax loss harvesting into our belief system, or that disciplined, repeatable process that we follow, or do you feel like you kind of buttoned that up?
I would just emphasize like the commonality is the systematic nature of both. Like Ron described the process in some detail. We just talked about the substitutes and how we're not just saying, well, gee, we need to find a substitute.
Yeah, right. Yeah, we know them ahead of time.
Right. And so the idea is that we're not just like waking up and like, oh, let me dust my crystal ball off and kind of see what I think about what makes sense to do. There's this like a rules-based process, and that applies related to tax loss harvesting. And as we've talked about in other podcasts, in a general sense, like it applies to the way we trade and the way we construct portfolios as well. So that's the main commonality I wanna emphasize. I mean, because you're usually looking at tax losses in a bear market environment, all the benefits of being systematic in that type of environment apply. Tax loss harvesting apply to the way we manage portfolios.
And I'd like to add something too. So from 2007 to 2009 bear market, it was nasty. From peak to trough, if you look at not like month end, but like daily, you were down around 60% from the high to low. I had the ability, unfortunately, because the market was so bad, is to do harvesting 3 different times during that process. Every time approximately the market went down about 20%, I would harvest. I have clients that have used those losses for such a long time, it's incredible. So it really, really benefited them. That's the one point I wanted to make. The second one is we have a stock strategy. Now, our hope with the stock strategy is for outperformance with less risk. That's our goal. We primarily run that in an IRA because it's not as tax efficient, but we can also run it in taxable accounts. And we do harvesting in that too. So the portfolio tends to have 68 stocks. Say 5 of them are down a fair amount. We can sell them, go to replacement, and come back. So it's not just it's with all of our portfolios. We can do that.
I'm glad that you mentioned that. I didn't want to focus too much on the harvesting for the stock strategy because the management of that can get a little bit more
complicated,
technical. Right? But then the last thing that I'll say before
one more thing that I wanted to point out, which I should have said before. One thing that's nice about harvesting, particularly in a down market environment, it gives us something positive and constructive to do. So it's like, hey, let's look at what opportunity this presents
that's actually
to create a benefit.
Funny and true.
As opposed to sitting and hiding and saying like, oh God, woe is me, everything is terrible. Let's go hide in cash or whatever. It's like, hey, okay, it is what it is. The silver lining is we have some tax planning we can do, and let's like maintain our investment exposures, realize this benefit. Like that's the productive benefit we can focus on realizing.
I'm glad that you said that because the conversation switches. It's more of okay, the volatility is there. Nobody can control that, but what can you do to benefit or take advantage of it?
That's exactly
and this
right.
is one of those things that you can do. Right. Yeah. The one last thing that I wanted to mention again before I close this out is while this is not, tax loss harvesting per se, it's related to it. Another thing, because we do extensive tax planning at our firm, another strategy that's worth considering, again, when the volatility picks up and you're looking at tax loss harvesting opportunities, which means there's some losses in the portfolio. That's also a really good time to consider doing conversions to your Roth IRA.
Right. Absolutely.
Just because you're able to move more shares into the Roth so that when it recovers, you're kind of holding a can of gasoline over a fire. It's recovering quickly, or I should say more quickly. But for clients, we hope that you found this informative. This is something that we're looking at. How often are we looking at harvesting opportunities?
Anytime the market volatility picks up, anytime like the market's dropping 10%, we run reports on a regular basis.
Yeah.
We have a trading company that we work with that I have them run the reports. I review them to approve them. So when volatility picks up, if one day we say the market's down 10% and all of a sudden we have a 5% one day, I just email and say, run it.
Yep.
So we're looking at it on a very regular basis. When the markets are strong, there's really not the opportunity, so we don't have to run it.
Right. So for clients, I would just say, this is something we believe in. We would just want you to know that we are doing this, for you in the background, always looking at the opportunity there. If you know somebody that you think might benefit from listening to this episode, or maybe not that people are sitting there talking about tax loss harvesting, but maybe you had a conversation with somebody and you think they'd benefit listening to this, feel free to share the episode. And, if you're not a client listening and you want to take a deeper dive into your investment strategy and see if there's ways you can become more tax efficient, our contact information has been, brought up during this episode. So don't hesitate to reach out. We hope you guys enjoyed. Thanks.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.